Hello and welcome back. If this is your first time here, I am Dr. Stock, Doctor of Education, and in this video I want to talk about the CPI and what's been going on with inflation recently, what the outlook is, some commentary on the Fed and their rate hikes and what exactly could happen with that, and then also I'll touch on the markets as well. So that's exactly what I have for you in this video. I do want to know, how do you get in contact with an amoeba? You use your cellular phone. All right, that joke brought to you by my mom. She texted me this morning, was pretty happy to have a joke for me to share with all of you here, and I know that she'll be proud to hear it. I'll tell her that I put it in this video so that she can go listen to it, and why not give her some kind comments to read, thanking her for the hilarious laughs down in the comments. Let's move on from there. In this video, I'll be showing you the Moo app, and I'll tell you later how you get up to 16 free stocks using my link that's down in the description. There's also a link for Patreon down there if you like my commentary and like to hear more, including my CPI research that I put out every month so that you can go and look and know exactly what to expect. I have my video out for this most recent one. You can still check that out over at the Patreon, where I give further commentary on what I expect coming down the road for it. So I do want to talk in light of what we have with this current CPI read. So like I said, link for the Patreon also down in the description. So moving on from there, let's pop up the consumer price index. Here's what we got. So for the release itself, we had 0.2% on month over month for all items, and then we also had that for core as well. So let me see if we can zoom in just a little bit. So I know there's a lot here. I'm going to move on. I'm not going to stick with this for very long. So I did, and we'll look at the charts for this, but I did say that I expected about 0.13% month over month. I was only off. It actually came in at 0.16. So I was off by 3 basis points on a core basis when we talk about that. So I'm pretty proud that it did work out about the way that I expected, and I was saying between 4.6 and 4.7, and we landed at 4.7, and that was also a rounded value that put us there. So, you know, it's pretty nice to watch that kind of stuff work out. So enough patting myself on the back. Let's move on. Take a look at these numbers. Let me zoom in some more for you. And I want you to take a look at these numbers that we had. This goes all the way back to January. And just look at the numbers that we have here for energy, that we have whole percentages up or down. And then down here, 0.8, 0.5, 0.7, 0.9, you name it. And then just look across for the different numbers that we have as well. Dropping down, we don't see any more 0.8, 0.9, except for maybe right here. One pops up for transportation services, which then pulled back to 0.1. And just, you can see the decrease across time. And I got to say that the trend is there. If the Fed is still looking at year over year values, like, I also want to bring that up on a chart to show you why we keep on persisting with these high numbers like we do. And then we can also talk about when we expect to see the numbers on a year over year basis really start to normalize. So let me move on from that. I was very pleased with the CPI. I was very pleased with my projection that I put out, and I'm excited to put out the one for August that comes out in September, and that'll be available first over at the Patreon, where you can download the spreadsheet. You can watch my video on the research, and I'll bring a summary of it in pieces anyway over to YouTube closer to that CPI date. So here's what we got. So let's move on from there. So what we're looking at here, this is on core, so not looking at all items, but just X food and energy when we look at this. And this is over the history of it. Let me go to a more relevant time frame. So here's from 2010 to 2023. And you can see the path that we were on, the fact that it's fairly a straight line, which means a steady increasing rate, which that 2% that the Fed talks about and being near that 2%, that's pretty much what we see. This is actually, I think, a little bit below trend, actually below that 2%. So here it is on a seasonally unadjusted basis. So from right here, this is July 2023, and to get to July 2022, look how far down we have to go. We have to go down about 1 1/3 lines to go from July 23 down to July 22, and that's 1 year's time interval. So it's over 1 year. And that big jump that we make, that's that steep climb. And that's why you see 4.7%, when in reality, when you look at the month over month numbers, those are a lot calmer. And you actually have this shape right here, which is called concave down, which means that the rates are decreasing. The rate of inflation is slowing down. So we have the deflationary pressures. The Fed said that they are at restrictive levels. They said that there's credit tightening showing up. So when we go back to, let's go back in here where we're pretty much steady with this climb that we have, what should it look like? So right here, I'm pointing at July 2018. Now, recently we had to go 1 1/3 bars down. If we go 1 year back in time to July of 2017, we don't even span 1 bar. There's July 2018. I'm just below the gray line. And to go back to July 2017, I'm just above the other one. So that's like half a line. So just looking at it in a visual perspective, not even quantitative, not even through numbers, the fact that we didn't make such a big jump is why year over year, back from 2017 to 2018, we came in a lot less hot than we are right now. And that's because of the steep climb that we have, but we are coming off that curve. And what the Fed doesn't want to see is where we are also rounding here back from October, November, December, that when we hit January and February and March and April and May, that we started to climb. And then after May, or starting at May, is where we started to finally round off again. The Fed wants to see that continue steady rather than spike back upward like it did this past January. But I would think that there was a big surprise in what was expected there, and there was a little bit more pricing power to squeak out. I think student loans are going to change things for us. We're going to have to watch that happen. Let me move on just a little bit. Sticky price inflation, because that also gets talked about. Let me go back up a little so you can see the trend that we had. So you can see the rise, the baselines that they kept on rising up, and now we started finally pulling back down on a rate basis. So now we're actually getting back to where we were with the sticky prices. And if we go to look at shelter, there we go, and we'll also bring that to a more relevant time frame. There we go. You can see the curve that we've been on, that we started to make that concave down appearance. So we get to see the rate slowing, and it looks like we're starting to return to what's right here. And I can't imagine under what we have right now with the price of a mortgage, for example, to be anything other than slowing down. And we have evidence to point to that. Now, I do want to show you just the mortgage calculator real quick. We'll look at the CME FedWatch tool and the markets. But check this out. So I didn't really change anything about this. This is just the calculator on Google. It defaults to 240,000, 30-year fixed. And this right now, I have it set at 3.6%. So this is assuming that the Fed really pulls back hard on that federal funds rate back to where we were, back in 2010 when I got my mortgage, as a matter of fact, or maybe it was 2013. I don't know, one of those two. Because I did a cash out refinance, and when I refinanced, I believe that I still locked in at under 4%. So looking at this, that mortgage payment that I would pay on a 30-year fixed for that $240,000 that we have, watch how that changes when we put it up to more recent rates. So change that 3 to a 7. Same house, 50% more every month in mortgage payment for the same exact house, just because the rate's higher. And that's one of the big reasons that we have for the housing market kind of being, well, really not a buyer's place, and I mean, I guess still kind of a seller's place, but the trouble is finding the buyers to go with it. One saving grace for sellers is the lower supply that we have in the housing market, which is helping to prop the house prices up. So should we see a flood of supply at some point in time, I think that we could also see a pullback in those housing prices. I'm not a real estate expert, so that's as much as I'll comment on that one. So I think supply demand has a lot to do with that, interest rate aside. But with the interest rate there, you're getting same house for 50% more money every month. And that's incredible. You're just just throwing extra money out the window at that point in time. So as a home buyer, if you could wait a brief period where property values either pull back or don't go up that much, where you could wait for lower rates that you expect to happen, not advice here, but me being in the market to buy some land and actually build a home on it, I don't want to do that right now. I don't want to take those mortgages out right now, because I'm going to be paying a whole ton more in interest to get the same exact property and just no added benefit to me whatsoever. So me as a consumer, I'm like, not right now. No thanks. And I don't think that I'm alone in that sentiment. All right, CME FedWatch tool. Let's look at September. Let's see how it changed since yesterday. So yesterday, there was an 86% chance of a pause for September. Now it's up to 90%. What's the difference? Biggest thing, in my opinion, is that CPI that takes place. They're still saying a 10% chance that we get. And I think that would be just that small chance that we deviate from trend on inflation. I don't know that we'll see enough by then to see softness in the labor market. I think that that's going to take until year's end. That if we will see softness in the labor market, I think by December is when we really start to see that. And I still think that it is possible that we start to see that first Fed rate cut come in by December or January as the different variables change. As of right now, where does the CME FedWatch tool have it? Where does the bond market put it? Right now, they're still saying that by December, we're right where we're at now with the federal funds rate. And they're saying, Dr. Stock, there's only a 12.5% chance right now that you're right, given what we know and what we expect to happen. So who am I to argue with the bond market? But we'll see when that time comes out as variables change, if it pans out to be true, if inflation should resurge. I'm definitely wrong on that one. So I do want to get over to Moomoo, and like I said, down in the description, you can use my link and you can get up to 16 free stocks. All you got to do is make a deposit of $100 or more, and you can check it out, the different tiers, that 5 free stocks for $100, $50 cash reward at every tier, 15 free stocks for the top 2 tiers. A deposit of $5,000 or more gets you 1 free share of Tesla or Google on top of those other 15 shares. So take advantage of that. And like I said, if you do like my commentary, check out the Patreon. Let's go to Moomoo. All right, so here we're looking at Moomoo, and we have the SPY brought up here, and you can see the red candle day that we had today. So as a matter of fact, if we go intraday, and just to see how the market reacted to the CPI report, at least initially, let's switch intraday over to pre-market. I want to know, can you pick out 8:30 without looking at the timestamps? Because it's right, let me see, right there where the peak is. Surprise, surprise. So we get a CPI read that looks pretty good, and at what I have on here is 8:31. We had a spike, we had a sell-off following it, and then it sort of settled after that. And you can see what sort of day we're having. So even though it was a great CPI read, it was still pretty much what was expected, and that sort of tells us about the market that we're getting today, at least in part. In my opinion, it was still upward pressure and staving off some of any other of the downward pressure that we have. There's still that big uncertainty coming up. There's a lot of people talking about, man, we don't know what's coming up ahead for us, and that the market hates uncertainty. And I think besides the rampant run-up that we've had in the markets, I think that uncertainty is part of what's allowing us to stop that run-up and start to pull back a little bit. And I still stand by what I said about possibly having that cup and handle look to the markets and retesting the previous highs that we had before we start to sell off again. So we'll see if that 50-day holds. That's that blue line that you have right here. 50-day holds, bounces off that pretty strong. We can be in good shape to rally up and retest that all-time high that we got in the SPY back here. That was all the way in December of 2021. Let's go to the Qs. So for the Qs, again, if we go to the intraday chart that we have here, it's set on pre-market. You can see the same spike happening, same sell-off happening, recovered a little bit after that, stabilized. And then when we go back to the daily chart, you can see the sort of day that we're having. As of today, right now, we are just above that previous close. We're about half a percent up. So that upward pressure is there. However, again, market uncertain, but check out that 50-day. I apologize, I'm still not coordinated. Bounced right off the 50-day, and maybe, just maybe, that cup and handle plays out and we retest that all-time high that we got at 404 before we start to see some of that softness return back to the markets. I don't know about that. Don't know that I'm right. That's what I can see happening from here, because I don't know that running up from right now really deals with the uncertainty that we have. So Apple, listening to their earnings call, that is impactful, listening to their earnings call, because they didn't sound very confident about the next quarter that's coming up. They're like, well, our services are good. iPhone sales, we'll see. And, well, Apple's price. Let me bring up Moomoo just one more time here, and then we'll wrap things up for you. AAPL. When we look at Apple's chart, let me zoom into what we have. Here's what we have following earnings. We sold off leading up to it. We sold off more after it. And it's possible that we sell off a little bit more for Apple. And Apple's a big player in the markets, and the market could follow a little bit of what Apple does. So Apple could recover with the markets, or Apple could be the thing that helps drag the markets down. We're just going to have to watch and see. So wrapping this thing up, the Fed, if they're looking to break the back of inflation, I believe they have. I think further tightening from here is not just breaking the back of inflation. It's also then throwing inflation into liquid nitrogen, taking it out and smashing it to pieces with a sledgehammer, and, well, putting us into a deflationary state. And that could be trouble, because a lot of times that also comes with recession, and that's something that we don't want to see. And if we're looking for soft landing and the market no longer sees soft landing, then that's something that can put downward pressure on the markets. So we're going to have to watch that, and I guarantee you that watching that federal funds rate through the CME FedWatch tool to see what's being predicted for the future of the Fed rate hikes is going to be highly impactful. So September, I think a lot of eyes are on September, and we'll see what the market does. September historically is not a great month for the market. That's another reason why I think that we could possibly rally through the rest of August and then into September start to experience some softness. We'll watch. We'll see it. Maybe it comes true like that. Maybe it plays out otherwise. The market is anything but predictable, but we still do the best that we can to understand the movements and try to look into the future for what's coming up for us. Thank you guys for watching this video. I really do appreciate it. Like I said, if you like my commentary, I'd like to hear more, You can be a supporter of my Patreon and get access to my Patreon exclusive content, lots of value and service over there, including access to my private Discord with me and my other community members where we can talk stocks and finance all day long and throughout the trading days. Thank you guys for watching. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.